on how to partner with the Nordic DFIs in East Africa. My name is Lanre Akinola. I'm with the Norwegian-African Business Association, and I'm going to be moderating the discussion. The webinar is a collaborative effort between Business Sweden, Business Finland, the Danish Trade Council, the Confederation of Danish Industry, Innovation Norway, and the Norwegian-African Business Association. Over the next 60 minutes, our goal is pretty simple. It is to provide practical insight into how the Nordic DFIs go about making investments in East Africa. So we're going to look at things like what their respective strategies are, what the investment criteria look like, what kind of sector focus they have, what kind of opportunities they're looking for, to sort of hopefully provide a better picture of how one might go about partnering with them in the region. With me to discuss this are representatives from each of the DFIs, and I will introduce them in the order that they will be speaking shortly. We have Audrey Obara, who is the Head of Health Investments and the Regional Office for Swedfund. We have Johanna Reihalme, who is the Head of the Nairobi Office for Finnfund. William Inyaoke, who is the Regional Director for East Africa at Norfund. And last but not least, we have Njeri Mungai Ingaruia, who is the Investment Director for IFU, that is Denmark's investment fund for developing countries. Now, the format is going to be pretty straightforward. We're going to start with a bit of insight from each of the speakers, who are going to get a few minutes to just provide some background on how their respective organizations approach the East Africa region, and some insight into how they partner, how they pick investment opportunities and investees. And then we will pick up the discussion from there, have a little bit of back and forth amongst the panelists. But we're very keen to also get comments and questions from the participants. There's a Q&A box. I'm sure you've all been on plenty of Zoom webinars by now. So please just post any comments you have in the Q&A, and we'll be sure to weave those into the discussion as well. Okay, that's all from me for now. We're now going to start hearing from our various speakers. And first, I'm going to turn to Audrey Obara. Give us a bit of an insight into how Swedfund operates. Audrey, the floor is yours.
Thank you, Lanre. Almost sounds like debate club when you're asked to take the floor. So Swedfund invests in three main sectors, two large ones and a small one, financial institutions and funds, and then climate, which covers mostly renewable energy, but we're starting to look at waste, water treatment, recycling, and forestry within that bucket. And then the smallest sector is healthcare. And previously, Swedfund looked at manufacturing and services, where we covered a lot more than healthcare. We covered hospitality, we covered manufacturing, retail, but in 2018 narrowed down into healthcare. In terms of what our capital is to be used for, we provide growth or expansion capital. So we want our capital to go into acquiring new equipment, into the business. We don't want to buy out existing shareholders. And if we do, it has to be for a very good reason, and a very small portion of the capital would go into that buyout. Tickets, we invest between $5 and $25 million for minority stakes. So we are a financial minority investor. We don't have sector specialists that sit in our teams. So we need to have lead investors that have that knowledge. So if it's a hospital, we need to invest alongside an investor who has managed hospitals before and knows what to do when it comes to running hospitals. And then we complement on the financial raise and in certain thematic areas. We can also look at investments in our thematic areas such as digitalization, gender, human rights, climate, sustainability as well, in addition to the main sectors. What type of companies do we look for? Given that it is growth capital and given the size of investments that we look at, it means these are mature companies that have able to take in, 50 million or 30 million of financing. If, Swedfund is contributing 10 as a minority and we have other investors on the table. We like to work with other DFIs. So all the colleagues on this call are some of the people that we are happy to work with, and also commercial and institutional investors, both local and foreign. Yeah, I think I stop there and pass the baton to Johanna. I'm not sure who's going next.
Thank you very much, Audrey. Yes, it is correct. Johanna is next. Some good background there. Well, we'll pick up on some of the points you have raised. Johanna, over to you.
Thank you. Thank you both. And actually, almost everything that Audrey just said, I could actually repeat in the introduction of Finnfund. So we are, all the Nordic DFIs, I guess, are pretty similar entities, but there are also some differences. So Finnfund is the Finnish DFI. We're an impact investor with over 40 years of experience actually in the markets. And as Swedfund, we do have a mandate to invest in privately owned companies across the developing markets. But in practice, there is a very strong focus on sub-Saharan Africa. So over 50% of our portfolio is in the region. And actually, if we look at the deal flow, it's currently probably closer to 75% of the new deals that we look that are in the sub-Saharan Africa region. We have also some priority sectors where we like to target the investments: renewable energy, financial institutions, sustainable agriculture. Sustainable forestry is probably a bit of a Finnish specialty, and we do have a dedicated team for those investments. Also, digital infrastructure and solutions is a newly established focus area within Finnfund, and we do actually see quite a lot of investments in that sector, particularly in the East Africa region. So that's a very strongly growing focus area at the moment. We always like to be minority investors, like Swedfund, especially in equity. We don't take bigger tickets than the project sponsor. We very rarely lead deals and like to invest with like-minded investors, other DFIs, PE, VC funds even. But we do need the co-investors to think alike in certain areas that are very critical to DFIs. So all the investments we make need to tick 3 boxes. They need to be profitable, they need to be sustainably run, so they do need to meet certain ESG criteria, and they need to create a development impact. So that's roughly the 3 boxes the investee companies need to tick. But otherwise, I would say our approach is pretty flexible and quite tailored case to case in terms of the choice of instrument, the ticket size. So there is quite a lot of flexibility also in the way we invest.
Thank you,
happy to elaborate on any of these points.
Yeah, just a quick follow-up. You said there's flexibility on the ticket size, but what's like the ballpark? What kind of ballpark figures do you usually target? Like what kind of range are we looking at?
Yeah, the sweet spot is probably around 10 million. We can go as low as 2 to 3 million in certain cases, and the upper limit is, we've done tickets up to 50 million, but I'd say 30 is probably the upper limit in most cases. Sorry,
I was muted. Thanks very much, Johanna. We're going to move on to Norway now. William, give us some insight into how Norfund operates in the region.
Thank you very much, Landre. So my name is William. Can you hear me? Excellent. So my name is William. The regional director for Norfund, based in East Africa, Nairobi. I think I'll start with what our mandate is as an institution. So our role is really to assist to build sustainable businesses in developing countries. And that means that we provide primarily equity and other risk capital, and that's in anything in between equity and debt. We are, as an investor, like the other DFIs, tend to be on the minority side. So typically from 10 to maximum 15%, 35% stake in any company. We take kind of active role in companies. So we're not typically a passive investor. So we would have a board representation in all companies that we take equity stakes in. On the debt side, we typically don't want to be the largest financial investor. So much as we can go up to 49% of the balance sheet, we tend to be below 40% just so that we have other investors around the table. So our role is to really catalyze private sector investments into projects, and we tend to come alongside other DFIs as well. So we see ourselves as a catalyst to bring others around the table so that projects can get implemented. In East Africa, our core countries are Kenya, Uganda, Tanzania, Ethiopia, and Rwanda, but we have extended reach countries where we go with partners like the DRC. We have some projects, special funds in Somalia, for instance, or South Sudan. So we tend to go really where others are not going, and so that we can prove that some of these areas are actually investable or have investable opportunities that people can focus on. In terms of sectors, primarily renewables. So most like half of our portfolio and soon to be more than half of our portfolio need to go to clean energy. And we talk about renewables, it's both grid connected and off grid. So solar parks, wind farms, hydro projects, but we also do what we call solar home systems, off-grid kind of projects. And right now in East Africa, we're really focusing on what we call commercial and industrial captive solar installations. So those people are familiar with this market. I think stability of electricity and cost is an issue. And a lot of industries are actually trying to be independent from the grid. So that's an area that we're really focusing on as an institution. We also in scalable enterprises, this is agri and manufacturing. Norfund's part of our mandate is really to improve lives. And I think the way we look at improving lives is to provide jobs at scale. And in our region, agriculture or agribusiness and manufacturing are sectors that we've identified as an institution to be those that can help us to provide jobs to East Africans at scale. So we are focusing in those areas. We also have what we call green infrastructure, and this is waste management. So we are getting into circular economy quite a bit. Water supply, as you guys might be aware, water is a big issue in our markets, both for industrial, domestic, and agriculture. So we're trying to find solutions, private sector-led solutions around these areas that we can catalyze capital to enter. As I had mentioned, our instruments are equity and debt and anything in between. So we do mezzanine with structured transactions based on the needs of the company and cash flow regimes that make sense for both us, the investor, and the investing company. In terms of ticket size, our minimum ticket in East Africa is $5 million for minority stakes. So you can imagine if we are going to be about 30-35% in a company with 5 million, I think the post-money valuation should be around 15 million or something like that. So we tend to work with companies that are not startups, a bit medium to large scale type of companies. Our sweet spot is 10 to 20 million, but we can also do larger tickets based on need. And especially on the clean energy side, we've done larger tickets when projects are big. For those who are in East Africa, you're aware, Turkana Wind is one of the projects that we helped to develop and bring to fruition. And there we had significant tickets. As I mentioned, minority stakes, maximum 35%. Target companies are privately owned, so we don't work with public sector owned companies. So for those around the call, make sure that we focus on private sector companies. We, as Finnfund, and I think Swedfund, of course, we focus on financial sustainability. So financial viability is important for us. So we are not going to invest in companies that are, not EBITDA positive or do not show track to being financially sustainable. So that's very important for us. Our capital is for expansion. As already mentioned, we invest in companies to expand. Rarely do we take out existing shareholders. If we have to, then it has to be a small portion of the total capital invested. For clean energy projects, we work with credible sponsors with experience that have done it before, that have skin in the game. We tend to look for projects which, when they're grid connected, that PPAs have already been negotiated and preferably signed, so that the time it takes to execution is a bit shorter for us. We look for ESG conscious companies, companies that do no harm, as it were. And we also look for strong management teams. I think that's for us very, very critical. In terms of do's for us, I think I mentioned some, but I think what is also very important is we look for companies that do good, have impact, create jobs, are environmentally and socially sustainable. Reputation is everything for us. So as an institution, we really, really work with companies that have strong reputation. So if you have dealing with, people that have tainted characters or that kind of thing, we wouldn't want to do business with you. So that's very important for us. Good governance, critical, transparency, checks and balances on the board, minority protections, timely reporting, external audits, those kind of things are important for us as a DFI. So if you want to interact with us, just check yourself in-house to see that your governance structures are working. It doesn't have to be perfect, but you are conscious about it, and we can work with you to get it to world-class or best practice. Don'ts, I mentioned, we don't do startups, buyouts. We don't invest in companies that do harm. So employees, community, environment, people who don't pay their taxes. We want you to at least contribute your taxes. I think when you come to us, we prefer that you don't misrepresent facts or oversell yourself. Because we do very thorough due diligence, and if we find out or we smoke out the things that were not properly represented, it can be bad for us. And then I think one don't for many people who try to work with DFIs is just don't be in a hurry to close. I think we are not necessarily slow, but when people come for investment that they needed funds yesterday, then it creates a lot of frustrations in the process and make our work very difficult. And I think for most of people around the table, we appreciate that DFIs have a bad name for being slow, but I think usually it's because people come when they need money last month and it just doesn't work. Misconceptions, Landry, I think you posted that. DFIs are not necessarily providers of cheap capital or concessional capital. So I think this is something that people need to be aware of. We provide market-based investments. We can be cheaper than commercial banks sometimes, but not necessarily. So I think that's something that people need to bear in mind. We often see projects coming to us looking for concession money or cheap capital. It's not necessarily that we are the cheapest. We don't necessarily favor impact over returns. So that's something that we want to see impact, but we also want to see financial sustainability. And we are not all the same. I think that's something that we need to bear in mind. We think alike sometimes, but we're not always like-minded. We are funded differently. Some DFIs, access commercial capital through the market. Some are funded from taxpayers 100%. So the way we interact with our investees based on our funding structures or the mandates we have can be different. And finally, we are not necessarily slow. I think that misconception about DFIs being slow, there's a lot of responsibilities on the company side as well, because how ready are you when you come to us? Do you have the right information? Are you ready for due diligence? Do you provide information in time when we ask for it? I think those are things that often companies don't take responsibility for, and it often happens that is the DFIs who are based for being, who are accused of being slow. But I think my world in this space for a long time, I've seen transactions in DFIs closed within 3 months, and some take 3 years. So it all depends on the counterpart on the other side and the willingness for people to actually collaborate and make a transaction work. And remember, don't come when you need money last month. Plan ahead. Thank you.
Great, William. Thanks very much. Very, very thorough overview of Norfund's approach to the region, and I see a lot of nodding of heads among the other speakers. So I'm gonna pick up on some of the points that William's raised there, because it'll be great to hear some thoughts from the other DFIs. But finally, to wrap up the introductory round, and Jerry, over to you, and let's hear from the Danish perspective.
Thank you. So morning, everyone. My name is Njeri Mungai Ngaria, and I work for IFU, which is the Danish state-owned development financial institution. We've been around for 50 plus years, investing in developing countries and emerging countries with a focus on sustainable goals. We currently have 1.6 billion USD in assets under management. We have a lot of similarities with the other DFIs on the table, so I'll try and not repeat what they've mentioned. But how we are set up is we have 5 core sectors that we look at. These are financial services, green energy and infrastructure, healthcare, sustainable foods, transformative businesses. We have offices spread out in the different continents, with a head office in Copenhagen. We have an office in Asia, offices in Africa, one in Nairobi, one in Accra, and offices in Latin America, and an office in Eastern Europe. Now, how we look at our strategic focus on investing: we are an active investor that principally invests through equity and rarely debt. So one of the criteria that most people think in regards to DFIs is that they typically would invest in debt more than equity. It is the inverse at IFU. We are principally an equity investor, minority equity investor that is active, that looks to drive impact and financial return. We invest through 3 different sources of capital, and William sort of touched on some of these items. So on top of being a Danish-owned, state-owned DFI, we also manage funds on behalf of private investors. And one of those funds is the SDG fund, that is about $750 million, that primarily invests in low risk, high impact return sectors and companies. And then we have a second pot of money, which is the high risk, high impact, that looks at transformative businesses that would typically not have high return requirements. So while the SDG would be looking at returns of about 10% on the euro and above, the high risk, high impact would be looking at lower returns with a maximum of about 10% on the Danish krona. And then we also have a focus on green, and through that we have a facility on the via the Green Future Fund. This is a unique facility that is earmarked for green interventions. It can provide debt, but can also provide equity-like investments, and this is spread out on all sectors. So with the focus on the different sectors and the focus on the different pots of money, our investment thesis is really around one, given the fact that this is growth capital in mature businesses. These need to be businesses, most of the time, needs to be businesses that have a very strong track record. We would typically be looking at businesses that have about a 10-year track record, have a good governance structure in place, have a good reputation. As William mentioned, reputation is very important for us, and possibly, preferably, have a regional reach. And now, in terms of investment size, it really depends on the sector, but more so the tool of funding that we shall utilize. For the SDG fund, we look at minimum $20 million and above. For the high risk, high impact, we can look at $5 to $10 million. For the Green Future Fund, we can look at $10 million ticket sizes and above. We typically will look at investments that have our core investors in place. So Most of the time, it would be the DFIs or private equity funds that have sector expertise. We would, given the fact that we would seek to be an active investor, most of our equity investments or equity-like investments would come with a board seat or a board observer seat. And in addition to that, we would also look at driving value creation and impact creation as key metrics. So while we would look at financial return, impact return is also very important. And more often than not, we will not invest if we cannot see an impact return in our investments. Now, one final thing, we can look at secondary transactions, but like most of my panelists in the room, we typically don't like secondary transactions, but if that is something that's on the table, we would look at them in light of, in addition to primary transactions, so money going into the businesses. In terms of criteria, I think I mentioned we look at strong businesses. For transformative businesses can take the form of startups. But I want to point out that these need to be transformative startup businesses that have a strong backing from reputable grant providers, for instance, have a strong backing from the regulatory environment, the public sector in the countries that they're operating in. So we typically, if we are looking at those startups, they would not be your random startups. These would be startups that are looking to really change businesses. And we have a few examples for that. We've invested in, together with Norfund, in a fund in Somalia. We are the first of the investors who've invested in a fund in Somalia. That would be typical of a transformative business, so to speak. We've also invested in an energy off-taker in Zambia, the first of its kind, together with other investors. That also would be a transformative business, and typically a business whereby it is supported by the government, it's supported by strong grant providers, it has a very strong founders on the table who know what they're doing, who are driven not by financial return, but by the impact return. And so the pot of money that we use for that would be the transformative pot of money, which would then fall into our high risk, high impact. I will stop there, Lanre, and hand over to you.
Great, and Jerry, thank you very much. Just a quick follow-up there. You said that you typically look for businesses with a 10-year record, and preferably with regional reach, but you also make exceptions for some startups. So the 10-year it's not necessarily a sort of hard rule. There are exceptions to that, but as you've just outlined, there's some fairly specific criteria for that.
And I think if you were to put it quantitatively, you could say 95% of our investments fall under that 10-year minimum requirement, because these transformative businesses are few and require a very long time for development. That's where they would fall under the 5%. So my focus, our focus is really on these strong businesses that already exist, that are looking for growth capital.
Great, thank you very much. All right, so we've got a nice overview now of the various DFIs. There's obviously quite a lot of similarity, but there are also differences. One of the things that stands out for me is like Finnfund stands out to me in that it's the only one that seems to be willing to look at much smaller ticket sizes. Joanna, could you give us a bit more of an insight into why that focus, and how does that change the sort of the addressable universe of companies that you can work with?
Yeah, absolutely. And it's also good to note that those smaller ticket sizes are an exception. So ideally, we would look at more mature companies with bigger tickets, because that's in a way how our internal processes are built. But we do make exceptions. We do find some very innovative, high impact, earlier stage growth companies where we do write these smaller equity tickets. But that's when the impact side of the story needs to be really strong. So that can justify an exception to that rule of the companies being EBITDA positive by the time we invest. So we have done some 3 to 2 million tickets to these type of companies, but normally the lower limit would ideally be around 5. But on the other hand, we do find quite an attractive actually space in these smaller to medium-sized businesses that are actually already too big for the very early stage venture capitalists to invest in, but they are too small for the bigger DFIs, for the big commercial investors. So there is actually a pretty nice niche in the 5 to 7 million ticket size range where we actually do see a lot of interesting opportunities.
Thank you, Johanna. One of the points that's come up a couple of times is startups. So startups are becoming a fairly sort of well, they're catching a lot of headlines these days, and the tech startup scene in particular in Africa seems to be buzzing. Where do startups fall into the picture here? William, you've already said that startups are basically a non-starter for Norfund, but it'll be good to maybe hear from Swedfund as well, or just any general thoughts that any of the speakers have on this. Who would like to go?
Can I say something?
William. Yeah, sure.
Yeah, so I think for us, we appreciate that, you know, there's not going to be a universe of investable opportunities if startups are not built, right? Because then it's like of a funnel, right? So you have to have a base that then feeds into the kind of companies we invest in. So what we do as an institution is to invest through venture funds into startups. So we have, for instance, Andela here that we put in around $3 million into their accelerator so that they can invest in these startups to bring them up. So we haven't, as an institution, it's not directly on Norfund's balance sheet, so we not go out to look for startups, but we partner with fund managers who are targeting those spaces and commit capital to them to do that job. And I think it's more about skill sets as well. So people who do the kind of work that we do are usually not the best to look at startups. So I think we appreciate where our weaknesses are and try to transfer that role to people who know how to do it best. So just to mention, Andela is one of them. We are in another VC funds around the region that do this work, and we believe that, you know, that is the way we can contribute best, as opposed to bringing those companies into Norfund's bureaucracy that will take sometimes can be very frustrating, and we might not even understand what they're doing and how to even to assess them.
Thank you. Would anyone else like to comment on this? Audrey, maybe would you like to comment on this?
Yeah, sure. Yeah, so I echo what William has said. So for Swedfund, we have invested in a few VC funds. It's a new sector strategy within our financial institutions strategy to reach these early stage companies. From the healthcare side, we have looked at a few directly, but it's difficult because we have an expansion capital mindset and we don't have the skill set internally for this type of company. So we are increasing exposure to VC funds, and in Asia, we're looking at transformation funds. So they're not exactly VC, but they do look at businesses that I would say maybe are a little bit past VC, maybe very few Series A type of funding, but B, C, and above, and you know, looking at innovation within healthcare. So that's our contribution to that space, not directly, mostly indirectly, and maybe with time, who knows how the strategy will evolve as we continue to see the gaps that are in the industry.
Great, thank you, Audrey. A quick reminder to all the participants: you can post questions in the Q&A section. It's very quiet in there at the moment. I'm sure there must be some questions out there. You still have time. But anyway, carrying on for now, we've spoken in quite general terms about East Africa, but give us a bit more of a sense of how the markets stack up. Are there which ones do you distinguish between them? Is it a sort of blanket approach, or do some of them stand out? So Kenya, naturally, one would imagine, would be perhaps a more active market than some other parts of the region. But when we say East Africa, what does that mean from the various DFI perspectives? Maybe, Jerry, you could start with that. It'll be great to hear from the others.
Sure. So one, we don't apply a blanket approach, and I would imagine it would be the same. As much as these countries have some similarities within them, they also have significant differences. So one of the aspects that we look at is the regulatory environment to determine how it works. Regulatory environment also in regards to the specific sectors that we look at and we focus on. So one example, for instance, financial services. When you look at financial services, Kenya is one country that sticks out in regard to that. If you compare that to Ethiopia prior to the war that they just had, financial services was a very closed off market. It was not open to investors. And so typically there was very little investment in that space outside of fund investments. So it's important to look at it in that light, looking at it from the outside in, and then, of course, taking into consideration the opportunities on the table, trying to see whether those are opportunities that align in terms of size that you're looking at, because not every company is able to take on $10 million and the governance requirements that most of the DFIs would have around the table. We also look at, are these businesses that are linked to government officials, which would typically be the case in closed economies. And then, unfortunately, that would then mean there'd be very little investment in that space until there's more liberalization in those sectors. So that's typically the approach for every region, and not different for East Africa. Kenya continues to be a key area, and that's why there are a lot of the private equity funds, the VC funds, have their offices and their bases here. But there is still quite a bit of appetite in the other countries, and the focus is stability, regulatory environment, growth in the sectors, players in the sectors, and opportunities to take on the minimum capital or debt requirements in place.
Thank you, Jerry. Would anyone else like to comment on this? No? Okay, good, because we have a few questions coming through. The first one I'd like to pick up is one to all of the DFIs. Is it a value add in your strategies if the investment is a joint venture between a local and a Nordic company? Does that have any bearing?
Happy to start. Not necessarily. I think some years back, there was, within Swedfund at least, a focus to do things with Swedish companies. But now we look for good businesses. So it would be a plus if there's a Swedish element there, but it's not a requirement for us.
And for Norfund.
Yeah, and pretty similar for Finnfund. It's not a requirement, although we would actually love to see more collaboration between Finnish companies and the local players. So we do encourage Finnish companies to invest in these markets, and we are happy to be part of those transactions, but it's not a requirement as such.
Yeah, and the same stands for IFU. We would love to see Danish companies, but not a requirement.
Great, thank you. We have another question here on capital markets. So it says, developing secondary markets and enhancing liquidity is instrumental to creating functional capital markets. How are Nordic DFIs working with creating liquidity, particularly in private markets where they operate? Is this even relevant to what you guys do? Ooh, William?
Yeah, I mean, look, this is a discussion we've actually had, on and off internally, and I think everyone appreciates that, private equity markets in Africa need liquid capital markets, and that's one of the issues why it's very difficult to invest in private equity in Africa, because exits are just very difficult. But I think from our core mandate, the the default is to invest in primarily in companies. I think there has to be a different conversation around creating funds that can then, start buying out private equity funds or other investors, and create a market out of that. So I think it's a structural issue. It's a very long-term play. I'm sure DFIs will play a role, but I don't think DFIs are the ones that are going to initiate that conversation. It has to be a private sector-led conversation, and then we will come in to support it as long as it makes economic sense. But we know as DFIs that there is a need there, but I would encourage private sector to take the lead.
Thank you, William. Anyone else have any thoughts on that, or does that cover it?
I think that covers at least Finnfund's thinking. We are aware of the problem, but we do think that would be the private sector's role to take. And I think the way we can support is by enhancing that primary capital market and creating that link also between the more concessional funding on the other hand and the private capital on the other hand, where, as I think William rightly put it in his introduction, we are in a way a catalyst type of financier, bridging that gap between different type of players in the market.
Thank you. We have another question here, specifically relating to SDG 5, which is gender equality and women empowerment. But the crux of the question is around the notorious missing middle. That is, companies that are too small to meet the sort of minimum investment criteria that DFIs have. And specifically here, the question is around companies struggling to raise funding in the $200,000 to $2 million range. And the question is, do the DFIs have smaller funds that they invest in with a focus that might address this missing middle, which is of course a very familiar issue or problem? A valid question. Any thoughts on, well, how, is it simply not the role of the DFIs, or is there a way to get down to that level?
Maybe I could
Audrey,
start.
please.
I could start. Yeah, I mean, I see a lot of opportunities that are looking for that size of capital. And on the fund side, I'm seeing a lot of the funds that used to look at smaller tickets also moving towards larger tickets. So a first-time fund will start off with, $1 million deals, but by the time they're on their second or third fund, their minimum is 5. Also, because of fund economics, a fund needs to be of a certain size, so they tend to start to move towards larger deals. Some of the VC funds are looking at maybe 500,000 as minimum, and they're looking for businesses where they can do a follow-on. So if it's a $200,000 business and they're not seeing opportunities for further capital in, say, a year or two, they probably wouldn't touch it. So there is that gap. And I think partly would still have to be filled by family and friends, which is a challenge in East Africa or Africa, because many people don't come from families where your father can write you a $50,000 check. In the US startups, it's very easy to go to your uncle and get 500,000. In Africa, it's almost impossible. We have a few angel investors, high net worth individuals that are funding some of these companies. Most of them I see in the fintech space, but if you're not in the fintech, yes, that gap does exist.
Anyone else on this?
Yeah,
Yes,
I think just to add to what Audrey said, I think you asked whether this is the role of the DFIs, and given the fact that the DFIs we are limited within our capacity to solve all the problems out there. We try to work in a complementary way with the other facilities that are out there, the VC players that are out there. But in addition, we also look at how we can help to facilitate access, because I think what you're talking about in one way is, or what the question is talking about in one way is access to capital for these SMEs. So one of the ways that we look at assisting them is indirectly investing in these financial institutions and in a manner to allow them to take on more risk. And this can be through guarantee facilities that help them facilitate more loans within the SME space, and thereby take on more risk, not ask for too much collateral for these businesses within the $200,000 to $1 million range. Because one of the things that I was asking myself with this question was, is it equity that is required, or is it debt that is required? And more often than not, it's possibly first family, friends, and fools, as most people would say, and then debt, building up the systems in place and building up the business before then going towards getting in an equity investor. And I say this because an equity investor is a very involving, active investor, such as ourselves or any private equity fund. So this is how we try to solve the problem by having a focus of investing in financial institutions that are earmarked to drive SME growth within that range of that 200,000 to 1 million, and allow them to take on more risk in a smart way without asking for those high security requirements. That's the role that I see us playing.
William.
Yeah, so I think both comments that have been made are very really true, and this is, we can't do everything, but the point I wanted to add is there's also a role that the family offices need to play, and especially in that smaller ticket space. And here I'm really speaking to family offices in Africa. Instead of people putting all their money in real estate and assets that do not really generate much, I think there need to be a mindset shift towards families or family offices, redirecting their capital to these kind of businesses, because DFIs cannot do everything. But I think there are pools of capital that are, in my opinion, really wasted or are put in dead assets that can be redirected to these businesses. And if you look at the abilities of some of these people within our markets, their understanding of businesses, I think there will be more value additional to these smaller businesses than a DFI, for instance. So I think that mindset shift needs to happen, and it's a conversation that also I think is going to come from the private sector as well.
Yeah, I guess the overarching point here is that DFIs can only do so much, and perhaps at times there's an expectation or that they can perhaps do more than realistically is possible, and without wider private sector development, it's just some of these things are just never going to take off, and that isn't necessarily the reserve of the DFI. We have another question here regarding it's actually directly at IFU and Jerry. Sorry, what is the ticket size appetite when it comes to startups? And is infrastructure one of the targeted areas?
So in terms of startups, we don't have a typical ticket size, and that's, as I said, because we don't focus on startups. We would look at it as transformative businesses. And so I would really want to strongly point that out. It needs to be a transformative business, and then therefore the ticket sizes can vary. They can vary from $1 to $10 million. I noticed that the question also asked on eco-industrial parks. For us, that would not be a transformative business. Again, not knowing the detail of it, we would need to see who are the partners behind it. But because these are typical parks that we've come across several times, in our view, that's not a transformative line of business.
Great, thank you, Jerry. One more thing I wanted to pick up on is William made a few observations around some misconceptions that people have about how the DFIs operate. He made the point around people thinking, we're very slow. That isn't necessarily the case. I'd like to bounce that off some of the other speakers from your experience, where are some of the sort of just kind of the gaps in understanding that people have or that you've encountered when it comes to how DFIs actually go about their business, which I think is one of the areas that's often overlooked. Is people kind of have these assumptions and we don't necessarily have the right picture. Would anyone like to comment on that?
Yeah, happy to go first. A couple of very good points have already been raised around these. I think the bigger one is probably that DFI financing would be somehow concessional. And that's not the case. We do take more risk than many typical commercial financiers. We can go to more difficult geographies, sometimes invest in greenfield projects that bear a lot of risks, but we're not able to give away financial return. We do look for high impact projects, but they do need to be commercially viable. They need to be EBITDA positive. Even the early stage companies that we invest in, there is sometimes, as I mentioned, an exception to the profitability rule, but there needs to be a clear path to profitability. So I guess that's probably the number one misconception we're facing. Another one is probably about the process. It's often thought that the companies need to already be compliant with a long list of ESG criteria, for example. But the companies don't need to be perfect from day one, but we are rather there to help them develop their processes and develop their standards along the way. So as long as the intention is right and the company is willing to improve the type of things that DFIs look for, we are there to help them along the journey. So they don't need to be perfect from day one. I would say those are a couple of the very general misconceptions.
Thank you, Johanna. Would anyone else like to pick up on this from your experience?
I think one of the other misconceptions is the view that DFIs will always step in to save the day, so to speak, in all investments, that we're there as a stopgap to any financing requirements, which is not the case. We would be looking to invest in strong entities or strong business plans with strong partners. And with that in mind, we look at an investment as a one-off investment that is principally driven by the founders and not as the players that would come in to save the day. So that's one misconception that I certainly do come across quite often, that needs to be, of course, rectified. We also do look at the commercial returns, and as a commercial investor, we would enter into every investment with that in mind, looking at the commercial returns as well as the impact returns.
Great, thank you, and Jerry. Audrey, would you like to comment on this, or have we covered it all?
I think there's good coverage, but I do want to reinforce the return aspect. A lot of people come to DFIs expecting grants or donations, or we're investors. I think that's a key differentiator from some of our other partner organizations like CEDA or development organizations within the DFI stable. As some of us get funding from the same pool of capital, but our mandates are very different, and the investment angle, I think, is something people struggle with when they come to DFIs. And then secondly is that we're not lead investors. So we take, we need a strong lead investor. We need to invest alongside people who know what they're doing, who understand that sector. We're not going to bring in that expertise per se. We can bring in experience from having done investments for many years in many different countries. But when it comes to the core, like skill set or technical capacity for that business, the management team or a lead investor need to already have that in place.
Great, thank you very much. We have another question here specifically on renewable energy projects. Is funding available for early phase and later project development, or only mature projects? I believe all of you do renewable energy, so it'll be good to get a sort of a general sense on that one. Who would like to go first?
Yes, I can do so. So yes, there is funding for under the renewable energy for early phase, early stage projects for as long as we do see a clear path to a sustainable point within a maximum of 12 months. And we provide that funding through a small facility that we have, which is called a Project Development Program Fund, a PDP fund. It has a limited amount of capital in place for those interventions. And we would be looking to put in money alongside the project founders. And this is because it's limited, it of course would be utilized for those projects that we believe merit the use of those funds.
Thank you, Njeri. Anyone else on this on renewable energy? Does anyone do early phase projects?
No, I think from our side, we rarely get involved in project development unless it's really transformational. But typically we tend to come towards the financial close.
Thank you. What about Swedfund and Finnfund on this point?
It's the same for us.
Right.
It's the same for us. We don't get involved in early phases.
And similar to us.
Okay. All right, great. We have 3 minutes left. And I think what I'll do is use those last 3 minutes to just get a final sort of quick round of responses from each of you. William earlier, he sort of had a bit of a tick list of do's and don'ts if you want to work with a DFI, and I thought that was quite useful, sort of quick fire, like, hey, here's some things to get right and some things that you want to avoid. And it'll be good to get a similar type response from the other 3 speakers. So from Finnfund, Swedfund, and IFU, what are some of the top do's and don'ts when it comes to working with your respective DFI? I'm gonna volunteer Johanna to go first.
As I probably mentioned in my introduction already, there are not very strict do's and don'ts, so it is quite a flexible approach in the end, but there are definitely some preferences. And one very good don't that was already brought up is that don't come to DFIs when you needed money yesterday. So we do want to actually be part of the discussions from quite early on. We like to tailor our approach to the specific financing needs of the company. We often also provide some assistance in further developing the business plan so that it's more attractive to a wider range of investors. So please do come just early in the process. Also, we do want to see quite mature businesses with well-developed business plans. So you shouldn't come to us in the early stages of project development. Also, it's a relatively complicated process eventually getting financing from the DFIs, even though we want to be very responsive. And I think all of the Nordics are probably the more agile ones out of the DFI spectrum. It is still a relatively heavy process. So please do come with a mature business plan that is easier to fund.
Great, thank you. Njeri and Audrey, some quick thoughts on this?
Sure. I think most of mine are do's, similar to what Johanna has just said. Do provide us with information as required. Do have a business plan, a financial model in place. Do change that or tailor that financial model to look at different scenarios. I think most entrepreneurs are open, typically would look at the best case scenarios, always consider the downside. That's what we would typically see. No one could have predicted COVID, for instance, so take that into consideration. Be patient with our process. We have our processes in place. Unfortunately, as William pointed out, we do have our minimum timelines. So for instance, with IFU, the fastest that we can move is to make an investment is 6 months, and that's typically with not a very complicated project. The other is to be transparent through the investment process, but also when you are our investee, we do look at a collaborative approach, and that's the only way that we can achieve the returns that both parties would be looking at. So please do be transparent with us. We want to see you succeed. That's it.
Thank you. Now we're a minute over. Audrey, do you want to have a quick final word here, or are you okay to
They've covered it very well.
Okay,
yeah.
great.
Yeah.
I saved by the bell there. Well, look, unfortunately, we've run out of time. My apologies. There's a couple of questions that we didn't have time to answer. Time is, as always, against us. But thank you so much to all the speakers. Great insight. I certainly have a better understanding of what the DFIs are up to in East Africa than before. And thank you very much for the contributions from the participants as well. Some good questions and some good comments there. And on that note, we'll wrap things up here. And I wish you all a productive rest of the day and rest of the week. Thank you very much.
Thank you.
Thank you.
Thank you very much.
Thanks, everyone.
It was a pleasure.
Bye-bye.